Ladies and gentlemen, good day and welcome to the United Spirits Limited third quarter FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Arora, Head of Investor Relations, United Spirits Limited. Thank you, and over to you, ma'am.
Good afternoon, everyone, and welcome to United Spirits third quarter and 9 months ended FY23 earnings call. Today on the call we have with us our Managing Director and CEO, Ms. Hina Nagarajan, and our CFO, Mr. Pradeep Jain. Hina will provide you an update on business performance, while Pradeep will run you through the financial performance during the period. Post which, we will open the floor for questions. With this, I hand over the call to Hina for her opening remarks. Over to you, Hina.
Thanks, Shweta, and good afternoon, ladies and gentlemen. Thank you for joining us on the Q3 FY23 earnings call of United Spirits Limited. It's always a delight to interact with all of you, and I wish you and your loved ones a very happy and healthy new year. I will first give a brief update on macro and industry, and will then discuss progress on our portfolio reshape strategy, followed by some business context of the results that we have announced yesterday evening. The consumption and the growth story of India continued in the October to December 2022 period, with India safely being one of the bright spots, I would say, in an otherwise gloomy global economy. This was the first full festive season post-COVID, where people celebrated both inside their homes and out of their homes with great fervor. I mean, we saw that Dussehra, Pujo, Diwali, even Halloween, Christmas, and New Year's. Premiumization and aspiration-driven choices continued to be the key drivers of demand, with greater growth coming from the middle and upper income segments in India. The lower income segments did feel a crunch in their wallets as inflation continues to be high, and that reflects in the lower end of our portfolio. Having said that, we would like to stay hopeful of inflation coming down and a boost in income owing to strong winter harvest. I mean, speaking of alcohol in particular, we continue to witness good growth post-COVID, particularly at the mid-upper segments of the P&A portfolio, and that is reflective of the consumption revival in the broader economic context, with the festive season adding further momentum as mentioned earlier. Our premium Indian whiskies and scotches continue to drive category expansion on the back of sustained trend of premiumization. Inflation and the larger global macroeconomic headwinds may act as a bit of a drag, but we believe that consumer demand will continue to be robust. Global data also suggests that the Indian consumer continues to be amongst the most resilient and optimistic in the world. Net, I would say the larger growth story pegged on premiumization continues for our industry. In this context, we have delivered a good performance in the quarter despite headwinds from route to market change and partial recovery of BIO into. This was also the first pristine quarter post the slump sale and franchising of the strategically reviewed popular portfolio. Pradeep will re-emphasize a couple of points that we have consistently communicated with regard to the divestiture and the franchising in his section of opening comments. During the quarter, we have also completed the merger of Pioneer Distilleries Limited and signed definitive agreements to divest the non-operated Sovereign Distilleries Limited. That progresses us towards a simplified legal entity footprint. I'm also very happy to inform that the Board of Directors has approved a multi-year supply chain agility program, which aims to strengthen our end-to-end supply chain, making it future-ready by improving its resilience and agility, driving efficiencies, delivering additional productivity savings, and making our supply chain and operations more sustainable. This is in addition to our focus on everyday efficiency savings. Just to take you through a bit more on the rationale and economics of the program with more detail, as we have clearly articulated on several occasions that being a combination of acquisitions and mergers over a period of time, USL still has a fair amount of legacy costs stuck in the P&L, and we want to accelerate towards our near-end state manufacturing footprint. This is exactly what we are trying to achieve through the multi-year supply agility program. The total program cost will hover around 500 crores, consisting of both cash and non-cash components in roughly a 60-40 ratio. Once completed, the program will generate 130 to 150 crores of annualized productivity benefits. Overall, the discounted payback would be about 4.5 years. There are also appropriate disclosures to this effect in our financials. Back to the impact of Delhi route to market and policy change, that is clearly visible during the quarter, and there is unarguably a setback for companies like ours with this change. We are doubling up our efforts to make up for this lost growth opportunity by sharpening portfolio execution, particularly on salient segments and brands like Black and White, Black Dog, Royal Challenge. We are harnessing the strong momentum of these offerings and also accelerating the reach of our innovations such as Royal Challenge American Pride and the renovation of Royal Challenge Whisky and Signature across other states in the country. Overall, we remain very pleased with the response received on our innovated offerings and new launches over the last few quarters and continued the sequential momentum of growth of the same in the October-December quarter. We also launched Johnnie Walker Blonde, the smooth, bright and light Scotch variant from the house of Johnnie Walker. Blonde is price positioned in between red and black and will play the strategic role of recruiting the next-gen non-Scotch consumer. We have also launched the renovated new Royal Challenge in many other markets. The renovation launch was done with a Choose Bold video from Virat Kohli, which reached about 12 million plus accounts. Complementing the same, we have created the Naya Sher Anthem, which was created in collaboration with Divine and Jonita Gandhi, featuring Virat Kohli. The renovated Royal Challenge has been rolled out in Assam, Rajasthan, UP, Haryana, Maharashtra, Goa, Daman, Diu, Chandigarh, and we are targeting a full national rollout completed by June 2023. On McDowell's number one, we continued focused investments. Pan-India launch of the new Yari song in December, which basically was a tribute to KK, who is the original singer of that song, and this is one of our strongest sort of brand assets, I would say. And that new song garnered 26 million plus views. The song aims to build salience for the brand across the country and drive brand love amongst the youth with celebrity handles, digital as well as new age platform promotions. On the digital side, we are continuing acceleration on consumer engagement, content and community building through our platform in.thebar.com, and we are also driving precision marketing for effectiveness and efficiency of our marketing spend. We create this virtuous cycle, therefore, of everyday efficiency, smart investment leading to top line growth. I am pleased to share that our consumer activations have been significantly recognized by the industry for their innovative approaches and best-in-class. To quote a few, the drone activation around Johnnie Walker, which we did in Goa, won a gold both at the Mobile Marketing Awards, MAGI, in the Media Innovation category, and at the ET Brand Equity Brand Strategy Awards for Tech-Enabled Media Plan category. Godawan Artisanal Single Malt won its first International Taste Award for both its expressions at the International Taste Institute Awards, Brussels, and our renovated Black Dog packaging has won World Star Award, which is awarded by the World Packaging Organization as the highest award in the field of world packaging. All this is a reflection of the work of our extremely talented team, underpinned by deep consumer insight and above everything else, our agility to adapt to the ever-changing marketing landscape. We will continue to invest in our brands by driving focused interventions, and over the coming months will further build up mental availability for our P&A portfolio and equity of our BIO brand. To sum up, we remain optimistic about the prospects of our business and confident in the resilience of our well-established processes and overall in our ability to navigate headwinds. In the last few years, our teams have demonstrated their ability to overcome several significant challenges. With renewed portfolio and razor-sharp focus on driving commercial excellence in-store and on-premise, revenue growth management and everyday efficiency, we are confident in our ability to deliver sustainable long-term growth and stakeholder value. With this, I hand over the call to Pradeep to take you a bit deeper into the financial update. Pradeep, over to you.
Thank you, Ina, and a very warm welcome to all of you. I would like you to refer to the results press release posted on our website last evening. At the onset, would want to make two terminologies clear that are being used throughout the document. One is reinstated, wherein all numbers are adjusted for the Pioneer Distilleries merger as it is effective April 2021. So, for the previous periods, these numbers are reinstated, while current period reported numbers are already inclusive of PDL. That makes it comparable. The second term that we are using is rebased. This is eliminating the impact of the strategically reviewed popular portfolio from the base years to make comparisons meaningful and absolutely like to like. Hope this will provide all of you a better understanding of the performance and the numbers. Now, before I come to the retained portfolio core operating performance, let me cover the impact of the slump sale and the franchising of the strategically reviewed popular portfolio. Since we have announced the deal in May 2022, we have consistently communicated that you will see two impacts of the transaction on our go-forward financials. A, divested perimeter will not provide any material pickup in margins as it more or less makes portfolio margins. And B, on fixed overheads will lead to an operating deleverage for 12 to 18 months, and we will have to recoup the same through a combination of growth stroke leverage over the next 4 to 6 quarters. If you look at the numbers released for the quarter, these are exactly the two things that are playing out, and we have consciously called out the impacts transparently, exactly in the manner in which we have been conveying it to all of you over the last 3 quarters, ever since we announced the deal. Now let's come to the core operating performance of the retained business. Like for like, we have delivered a portfolio NSV growth of 9.7% during the quarter. Underlying growth stands at 11.5% after adjusting for the one-off bulk Scotch sale in the prior year same quarter. Prestige and above growth stands at 11.7% with double-digit growth in our Scotch portfolio. The price mix during the quarter was 6.5%, reflecting the higher growth in more premium segments as we move up the consumer price ladder. The continued brunt of inflation, which remained at double digits, approximately 11% for the quarter, and partial BIO normalization adversely impacted gross margins. Our marketing reinvestment rate during the quarter was 10% of net sales. As mentioned by Hina, we continue to drive customer-centric activation, strengthen our brand equity, and premiumize the portfolio. EBITDA was rupees 368 crores and EBITDA margin was 13.2%. Exceptional charge of Indian rupee 151 crores is on account of the supply agility program approved by the board. Reported PAT for the quarter is at 111 crores, impacted by the supply agility one-time restructuring charge. As we look ahead, input commodity inflation is expected to remain high. Having said this, our sustained efforts on pricing and productivity are also yielding results and will reflect higher run rates in the subsequent quarters. On A&P, we have done targeted calibrations earlier in the April to September period. With full normalization of BIO supplies expected in Jan-March, we will invest in the brands to ramp up equity and regain the lost ground. As always, our focus is on the circle of control rather than the circle of concern, and we continue to work towards expanding the pipeline of value chain productivity and revenue growth management initiatives. Right? So I would like to hand over back to Hina for a very, very special update which is hot off the press, and then we can open up for Q&A.
Yeah, so hi everyone. I just wanted to share this, it's right off the press as we speak. Very pleased to announce that our 100% subsidiary, Royal Challengers Bangalore, has acquired the women's IPL team for Bangalore just now, as the BCCI bid, process closed, over the last 2 hours. We are very delighted with this because, this is really taking forward, the narrative of inclusion and diversity that we have led, particularly for our industry and, in a broader context in India and globally. And, it gives us, it fits perfectly with our purpose of celebration. Cricket is big in this country, so having this additional platform of women's IPL, fits hand in glove with our purpose and values. So delighted with that. With this, Pradeep and I would be happy to answer all your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jay Kumar Doshi from Kotak. Please go ahead.
Yeah, hi. Thanks for the opportunity. A couple of bookkeeping questions. The first one, when I look at the bridge between 470 crore of reported, 490 crore reported EBITDA last year and 420 crore rebased EBITDA, the impact is 70 crore. So, our understanding at that point of time was that, the EBITDA impact or EBITDA of the divested portfolio as some sale as well as franchising portfolio was 195 crores ballpark in FY22. And post this transaction, you were expecting certain royalty income. So net impact of the business that was sold or franchised would have been somewhere in the range of 170 crore. And over and above that, what I understand is the operating leverage impact that you're calling out is another 100 crores. So is it right to understand that if I look at your FY22 EBITDA, the impact of the portfolio that has now been divested on your EBITDA is going to be at full year level somewhere in the range of 250 to 270 crore? Or if you can tell me what the rebase number for FY22 full year was at standalone, the equivalent of 420 crore at a full year level.
Okay, Jay. So let me take this. That's why I did kind of want to cover this in my opening comments as well, right? We have always consistently said that there are going to be two comments. Yeah, there are going to be two impacts, right? One is the EBITDA of the divested business that it makes after a full loading of overheads, right? I mean, it's a very, very convenient living room view, right? That the marginal contribution can be taken as the, as the EBITDA of the, of the business. That's not right? I mean, to run a sustained portfolio and a business even of 1,500 crores, you require corporate functions, right? So therefore, those corporate functions on a fully loaded basis is the 42 crores that you are seeing, right? And then the second thing we've always said is that those central corporate functions obviously don't go with the deal, right? And very loosely, I used to take the joke of my own salary. My own salary doesn't come down, right, once I divest the portfolio, right? So there is a deleverage on account of that, which we have consistently maintained. We will take about anything from 4 to 6 quarters through a combination of growth and obviously our continued discipline on discretionary overheads. I think we've established a fairly good track record over the last 4 to 5 years of maintaining a fairly disciplined organization on discretionary overheads, right? So that's the way one will really have to look at it, right? So I don't know whether that answers or not, right? So basically what I'm saying is what you see the 42 crores in the quarter, that's the core fully loaded basis EBITDA that is losing. Rest is timing. We will recoup it over the next 4 to 5 quarters as we grow the business back to the original.
Understood.
Does that answer, Jay?
I understood. Got it. It's just that we didn't anticipate, at least I didn't anticipate 110, 112 crore kind of annual de-operating leverage impact. So my understanding of the underlying EBITDA was higher than what the reported number.
Yeah. No, absolutely. Right. And since you have raised this, I would want to clarify that we have been very, very clearly in articulating that there will not be any mathematical pickup of the margin, right? But if you look at the numbers, there is a mathematical pickup purely due to the dilutive part of the portfolio going away, right? So if you combine the two impacts, the net impact on the EBITDA margin is roughly about 40 to 60 basis points, which is playing out whether you look at the quarter numbers or whether you look at the 9-month numbers, right? So I just wanted to kind of, balance that picture also.
Understood. Second question is, can you explain a little bit more about this program, supply chain sort of program that you've initiated? And what will be that? Look, on 500 crore, 60% cash impact, it's like 300 crore of cash cost. So what is the nature, of this cost? Is it entirely going to be severance? Is it going to be 300 crore of severance that you will have to pay in the next maybe 3 to 5 years?
Yeah. So Jay, again, by and large, we have a very, very detailed descriptor in our financials that will give you a good sense, right? But we did want to, share the highlights, right? And again, we are being consistent with what we have communicated to you, right, over the last 3-4 quarters, that this is something that we are working on, and we will want to accelerate now, right, towards our end-state manufacturing footprint. And it's becoming extremely difficult to kind of do them on a piece-by-piece basis, right? So therefore, we did want to, announce this multi-year program, and yeah, I mean, you can make reasonable guesses on where the costs would be, right? The costs are largely on account of severances and on account of the write down of the asset values of the assets that we'll probably close towards our progress to the end-state footprint.
Understood. Lastly, could you comment on the inflationary trends in case of ENA and glass bottles, and what is your outlook on gross margin front? Where does it go from the current levels over the next 1 or 2 quarters?
Yeah. So Jay, look, I mean, I think Hina has also covered it in the press release itself. The RMPM still continue to remain inflationary, though just to balance, I would want to say certain smaller mix elements have started coming down also, right? Paper has started coming down, PET has started coming down, but these are not the big drivers of our COGS portfolio, right? ENA is kind of flattish, I would say, right? But glass continues to be inflationary, largely driven by the natural gas inflation, et cetera, right? And the capacity is completely kind of choked, right? I mean, it's pretty much a seller's market right now, right? So that, but having said that, as we have mentioned, all the work that we have done in ramping up our productivity run rates and all the efforts of the last 2-3 quarters, etc., the higher pricing run rates and the higher productivity run rates will also start reflecting in the quarter. So therefore, net to sum it up, we believe, even if you look at the gross margins of the rebased portfolio that we have mentioned, we are pretty similar to the last quarter, right, on a sequential basis, right? So we would right now want to believe that it seems to be bottoming out, right? And as our pricing and productivity kind of run rates ramp up, right, hopefully we can reverse the trend from next quarter on.
Understood. Thank you so much. That's it from my side.
Thanks. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks, and congrats on winning the women's IPL team for Bangalore. That was my first question. So, what could be the medium long-term impact of this on your brands and revenue? It's a very interesting development. But the fact is that the rights have come obviously quite expensive. When I see it is, as BCCI has received more money than what they received for the men's team in the first year. So obviously a lot of time has gone, but RCB is paying around 900 crores for this. So what would be the revenue and brand impact long term? And if near term, how do you see in terms of the impact on the profitability? Because this is something which is currently going to be in nascent stage.
Yeah, so Abneesh, thanks for this. So look, on profitability, right, I mean, it is a bit of a portfolio game. Yes, this is a long-term bet, right? I mean, if I go back to the men's IPL also, since we have the history and we have seen it organically play out over the last 15 to 17 years now, it did not make money for the first 10 years, right? But the good thing about this investment is, and all of you are aware, it kind of times perfectly with the new cycle of the men's IPL and the new media auction cycles of the men's IPL, right? So we are fairly buoyant, right? That is going to provide a kicker into the into the men's IPL profitability, and a part of that will be consumed by the women's IPL, right? But longer term, genuinely, right, from where the women's IPL cricket viewership penetration stands today, it can only grow by leaps and bounds, right? And therefore, it's a long-term jewel that we are picking up, in our portfolio. And obviously, the 3 or 4 reasons that Hina mentioned at the outset, right? that kind of provide a kicker to our core alcobev business as well. Hina, do you want to add anything?
Well, I would just add that actually we have taken a very conservative view over the next few years of what women's IPL could do. And even there, the business case made absolute sense. So we have gone through a proper, due diligence process with the board globally, and we believe the business case is very robust for it. And like I said, Abneesh, I think the impact, this is right up, where Diageo purpose and value stands, right? So I think our focus on inclusion and diversity, we have stood for mixed gender, cricket in the past, and this is taking that narrative forward. So I would say it's a very strong affirmation of our business stands for. And we believe that this will only strengthen our overall equity as a business, being a strong revenue case over the next few years.
So thanks. My second and last question is on the premiumization and the packaging. So in premiumization, you have delivered good consistent growth over the past few quarters.
Yes.
Would you be a bit worried because of the startup job losses? IT net addition has been at a multi-month low. Would you be worried on that in terms of the outlook, not from a Q3 or Q4, I'm saying more on the FY24? And on the packaging bit, in terms of the innovations and cost savings which you are driving, next 3 years, could you talk about that? What exactly would you be doing and how much could be potential savings there?
So, Abneesh, to answer your question first, we are seeing this in India and globally actually. The premiumization story has, remained quite strong if you look at, mid to upper segments, as I said in my opening, script, that basically we don't see a slowdown there, right? We are seeing robust growth and we expect that premiumization trends to continue. In a sense, because we are not a daily frequency purchase item, right? And people only purchase a bottle every month or 2 or 3 months, right? We are not really comparable with the grocery items and the regular consumer FMCG. So our story doesn't get as impacted by inflation as, the daily consumables do, right? So we are not seeing a slowdown. Actually, the only little bit of slowdown that we see is towards the lower end of prestige. And, it is difficult to say conclusively whether that is, there to last. I think there might be some slowdown on upgrades from, country liquor to popular business, which is the key source of growth for that segment. But difficult to say, so we continue to watch that segment over the next few quarters. But beyond that, I think we see the premiumization story and the growth quite robust. And we see that in global trends as well. Even pessimistic markets like the UK, which is currently the most pessimistic market on consumer sentiment, we are experiencing a slowdown in alcohol sales, right, and the premiumization. So I think we are quite confident that, the fundamental growth trends will continue.
Right, and on the packaging bit, packaging cost?
On packaging, look, you are probably referring to, the removal of IPCs, which we have started doing, right? So that was definitely both a sustainability and cost-saving initiative, of course. It brings cost savings with it. So we have started that. I will talk about our innovation as we go along. I can't really talk about it, in advance, but there's a number of innovations that we are looking at, which are both to, keep our growth momentum in prestige and above, and also, accelerate our sustainability journey, because that's also a very critical pillar of our strategy. And, whether it's alternate formats or whether it is more, innovative packaging, we are working on that. The technical team is working on that, and we will be announcing these at the appropriate timings.
So thanks. That's very useful. Thank you.
Thanks so much, Abneesh.
Thank you, Abneesh.
Thank you. Participants are requested to please limit your questions to 2 per participant. The next question is from the line of Manoj Menon from ICICI Securities. Please go ahead.
Hi, team. Just allow me one to follow up on a question on the profitability of the divested portfolio, because that is one of the question which many investors have been asking us since yesterday. Look, if I look at the 9 months profits, right? So it is 110 plus 80. So that's am I supposed to add these to 190 divided by 983, which gives me a mathematical outcome of 19.2% EBITDA margin? Because cost is cost, right? Whether it is corporate costs or the other variable costs, etc. To begin with, is that the right way to look at it? That the divested portfolio actually had a 19% EBITDA margin, cash, non-cash, everything included.
Yeah. So Manoj, that's not the right way to look at it, right? And that's why we have consciously kind of, split the numbers, right? And we have tied in with the consistent narrative that we have shared over the last 7-8 months, ever since we have announced the deal, right? So the 110 is with the corporate overheads that portfolio was absorbing, right? And even after we have kind of sold that portfolio to Inbrew, etc., they have also had to set up that corporate organization, right? So that's the broad pointer that I'm making, right? That to run a 1,500 crore business, right, anyone will need a reasonable size corporate organization. Now we can dispute, we can debate whether it should be 28 crores per quarter organization or it should be, 20 crore per or it should be 35 crore, right? But the fact is that you need central support corporate organization functions, right, to run that machinery, right? So that's the way we set. And the second thing is we've always said that, look, when this happens, there will be an operating deleverage, which we will recoup as our experience in other parts of the globe when we have divested the tail end of our portfolio, etc., where we do not have a longer term right to succeed. We believe that we will be able to accelerate on our P&A growth, etc., to be able to recoup this over the next 4 to 6 quarters, right? So Manoj, that's pretty much the story, consistent with what we have said from May onwards. Now that the first quarter has come in, I am equally transparently sharing the numbers as they are.
Understood, Chief. Now, the only follow-up which comes here, and I'll take it offline, is that this 80 crore calculation for 9 months, is it volume indexed or volume linked? So, I mean, that's a reason it's a higher number than what many of us thought.
No, so it's, okay. I mean, the way we allocate corporate overheads is straight percentage NSP, right? All the direct overheads, etc., have anyway gone with the deal. Right, so the people who are dedicatedly working for that portfolio, the plant, for example, that one own manufacturing facility, all those have gone with the deal, right? So these are we just allocate on percentage NSP basis, right? So if our full corporate organization has fixed overheads of, let's say, 7 to 8% of NSP, we just load the 7 to 8% of NSP on all segments of the portfolio.
Very clear. So just quickly, the second question the actual pricing which you would have got, let's say, in 9 months this fiscal, with geography, some granularity if you can. And one theoretical question I had is on let's say initiatives like monocotton removal, etc., which I presume is an industry-wide practice, at least definitely in the top companies for sure. Can it, redefine the industry profit pool higher, or because everybody is doing it on a like-for-like basis, it is likely to get expensed away? Thank you.
Yeah. No, so maybe I'll take the first question, right? Yeah. So on the pricing, Manoj, I mean, here are the broad headlines, right? So if you talk of the quarter, right, we've got good pricing, price increases from, I mean, just call out 4 states definitely, right? West Bengal, Delhi, Odisha, Karnataka, right? Those are the 4 states, and obviously our long pending application with CFD, we've also managed to get some price increases in CFD, which is very, very difficult to get, but we have managed that also, right? And a couple of other small states, right? I know that, Daman and Diu, we've got some pricing, etc., right? But overall, at a slightly elevated level, I do want to say that if you look at the July-June performance here of Diageo, right? I mean, that's the way, Tina and I do live a schizophrenic life, right? April, March, and July, June. But if you look at July, June, right, we are trending towards probably one of our best year on pricing, right? And broadly, we right now have a line of sight to about 2% of our NSP, right? And 2% pricing we've never got in the last 5 to 7 years, right? I would probably say it's the highest since the acquisition. Now, having said that, it is still only a fraction of our inflation, right? So,
hence the focus on mix.
Always focus on, mix and, and productivity, right? So hope that answers the pricing question. Yes. Now, second question, maybe I'll request, Hina to build after what I have shared, which is, will it redefine the profit pool? Look at the entire monocarton removal and packing. See, Manoj, the conditions in which it is happening, right? Like I said, it was a sustainable initiative. In the current inflationary conditions where your COGS is inflating by 11% and you are getting probably pricing in terms of percentage terms only at 20%, even at 2%, right? Is only about 20% of it, etc. I think it's just kind of helping counter inflation, to my mind, right? But once the inflation kind of, normalizes a little bit and we see some sanity coming back, etc. Yes, absolutely. That kind of comes into the profit pool, and then it's up to each individual player to make the choices that they want to do with that profit pool, right? So I don't know, Hina, whether you want to add something.
So I don't think there's anything to add. Absolutely. In this current environment, I think it is just going towards offsetting the cost. And of course, it is helping on sustainability. At the moment, sustainability is the bigger driver, right? So I think it's a wait and watch area. Very difficult to say whether this will, change anything because the environment still looks quite tough.
Does that answer your question, Manoj?
Absolutely, loud and clear, please. Thank you, Hina. Thank you so much.
Thanks so much, Manoj.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, Pradeep. Hi, Hina.
Hi.
Just a small clarification on this EBITDA margin bit. Now, the way I just wanted to, get very clear, the way we would be right in kind of looking at it is the 15% 9-month number, which I think from a full year basis should be, probably similar percentage on a full year basis. That is the level at which you would look to reach back in the next 4 to 6 quarters on the back of scale benefits. That's the way it would be apt to kind of look at that, right?
Absolutely.
Yeah, absolutely, Avi. That's the right way because that's the middle block of the bridge is our retained portfolio now, right?
Yeah.
And that's what we need to focus on. That's what you guys need to look at. That's what we are, maniacally focused on. And you're right. I mean, yeah. So.
No, absolutely. That's the
So you've got it absolutely right.
So that number, what would it be on a full year? Because we don't have that benefit. That's what I would, it's just to get us, clear on what is the target that you internally are looking at, and we are also aligned on that. Could you give us a sense of what that target is for FY22, which went by when you do this adjustment?
No, so FY22 or FY23? So, I mean,
22. So, I mean, what the actual was. 15 is the 9-month number. Is it the same for FY22 and hence, because see, quarterly things remain volatile. Yeah.
Okay. We haven't done that, Avi, right? Because, there was so much of work this time. We haven't yet done that, right? But when we come to you in May, we will anyway have that number, right? So we will, the way I'm seeing it is till we start lapping the the divestiture of the popular portfolio till September 30th, we will pretty much continue with these bridges, right? So you will get a sense. It will not dramatically differ, I would say.
Okay. And just clarifying on that, the inflation aspect that we are witnessing is just, something that will probably be impacting the time it takes to achieve it, which might be, that is why the 4 to 5 month range that you are, quarter range that you are looking at. That's the right metric that you are also kind of believing it, right?
That's right. Absolutely right.
Okay, perfect. Just 2 clarifications, bookkeeping, if I may put. One is the, this women's cycle. Congratulations on that. Any sense on the likely near-term impact that I should build in? Would it be more like 900 divided by 10 plus some number, so it should be around 60 crores or so, or any sense of that number or what your math is? A, and B, is there any one-off in the subsidiaries this time? Because which the sales, when I do Concall minus standalone, the sales comes out to be negative. Those are the 2 clarifications. Thank you.
Okay, so on the first one, right? Obviously, the 900 crores will be amortized over a period of 10 years, right? Now, we don't know how the rest of the IPL maths will work, right? And we've done some modeling based on our learnings of having handled, seen the men's IPL progression. So we have to wait, right? For, the good thing is the tournament will happen in March, right? So whatever local sponsorships, this, that, etc., we will want to wait for one cycle to complete before we can provide, right? But as I mentioned at the outset to Abnish's question, the good thing is that bump of investment is happening in the year in which the men's IPL media auction cycle is changing, right? It's going. So therefore, that should provide a profitability kicker, right? Which will hopefully, and the impact of this, let's say, the 90 crore amortization of the 900 crores should be consumed by that kicker on the men's IPL profitably. So that's a very, very broad model in our mind right now. But obviously, we need to wait for things to emerge over the next 3 to 4 months.
Perfect. And the subsidiary bit, is there any one-off over there?
Bit, I'm just kind of quickly jogging. No, so there's nothing on the subsidiary bit, right? I mean, since there's a lot of action in this quarter, I'm assuming that you have read about our signing the definitive agreements on the sovereign distilleries, right?
Yes.
That was a 12-year idle, non-operative asset that we finally managed to dispose, right? So we are happy with that. That will lighten the balance sheet. We haven't taken any charges on account of that. That was fully provided for over the last 7-8 years, right? That's one. And the second thing is, you would have seen our announcement on the follow-on funding of Now Distributor, of Now Beverages, right? So apart from that, nothing around the subsidy.
Okay. I wasn't able to understand why the subsidy, console sales were lower than the standalone sales. That's why I was asking, but that's okay. I can take it offline with you.
Maybe, Shweta will probably get back to you, right? I will also understand the query a little more. Yeah.
Okay. Thank you.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good evening, Pradeep. So my question is on the P&A sales. So last quarter, we had done a 22-23% P&A sales, the 3-year CAGR, since YOY growth can be disrupted by COVID. We are looking at 3-year CAGR, so that was around 14%. And in the Concall last time around, you had mentioned there are pluses and minuses affecting this number, but overall, they cancel out each other and there is no one-off at an overall level in this 22-23% kind of a top-line growth. Now, this quarter, we have fallen to a 12% kind of top-line growth on P&A, and the 3-year CAGR has decelerated from 14% to a 10% kind of a level. So just wanted to understand what really has changed for the demand outlook to suddenly change so materially in one quarter. And if 10% is a 3-year CAGR now, and now this quarter has been absolutely normal in terms of sort of demand, is this an indicator of what the P&A portfolio can grow at in future?
Okay, super. Perfect. Great question. And we were mentally prepared for this. so I'll just say that I don't think we ever said that the pluses and the minuses are cancelling each other, right? I thought what we said was that this 23% is clearly not sustainable, right? So I'll tell you what is happening. On a sequential basis, if you look at it, Delhi is the big joker in the pack, right? I mean, for the last 4 quarters, up till July-September quarter, from October-December of last year, Delhi was adding about 4 to 5 points of growth, right, to our national portfolio, right? And with Delhi kind of reversing completely, that positive kicker has become a negative kicker, right? So Delhi was adding, I would say, probably 3 to 4 points of growth, right? And it will still stabilize. It'll still stabilize further in terms of the negative direction over the next 2 quarters, right? So essentially, the swing is Delhi, right? Delhi, the plus 3-4 has become a negative 1-2 from October-December onwards, right? So that's broadly the 5 to 6 points of swing, right? That's one. Second thing is, around the same time when the Delhi bump up was coming, West Bengal had also favorably changed its RTM after the industry's kind of continued 1-year advocacy with them, right? If you remember, post-COVID, they had taken some 45-50% consumer price increases, et cetera, right? So that benefit now we have started lapping, right? It had opened sometime in October 21, so huge growth of 4 quarters, right? And therefore now we have started lapping, so that's another 2 to 3 percentage points, right? So that broadly explains the 23 coming down to the 12, 13, right? I mean, that's broadly the math, right? Now, third thing, I mean, it's just that last year, right, with Delhi, BIO being so salient there, etc., we had an absolute cracker of a quarter last year, on BIO sales. And this time, BIO, as we have said, Hina mentioned in her opening comment, it's not fully normalized, right? So hopefully it will fully normalize in January.
A large part of it has now come in towards the end.
Towards the end, right? So the whole quarter did not see a full normalization. So therefore, lapping a very high base on BIO, and obviously we couldn't kind of repeat that, in October, December, right? So those are broadly the three reasons.
But I would like to, though, say one thing, right? I think for our industry, where, we have route to market changes quite often, as you are aware, you follow the industry, I think it is probably not right to look at one quarter in isolation, right? We've got to look at, a rolling 4-quarter performance to understand the performance of the business, because there are these ups and downs that happen in every state, and we know how to navigate them. But in a particular quarter, they can, disrupt the picture, right? So I would say that if you look at the rolling 4 quarters, you're right. The, growth has been that 14-15, and I think that is our aspiration. This is exactly what we told you, that we want to continue the momentum to that. So I think that's what the team works on. So I would really request you to look at a rolling 4-quarter performance rather than an individual quarter and, try and take a trend out of that, because that doesn't really work for our industry.
Absolutely, Hina. But also given that bases are a little skewed on account of COVID, I would look at a 4-quarter rolling number, but on a 3-year CAGR basis. So,
what I mean is that, going forward, now that COVID is out of the way and we'll start, we've normalized the basis, right? So going forward, we will, it would be appropriate to look at the 4-quarter rolling sort of thing. Of course, you do your, CAGR analysis, etc. And the other thing I wanted to add is that, growth, obviously the team is working on, looking at how to recoup whatever part of that growth from other states and, driving the momentum with the fantastic launches that we've had and where we are seeing so much momentum on our innovation and renovation. So we will continue to aspire to deliver the kinds of growth that we have spoken about in our strategy, right? And we have delivered. Yeah.
And maybe just one build, I'm kind of responding to your remark, Percy. The 3-year CAGRs, right, you get into 2019-20, right? So just be conscious, right? Andhra Pradesh is also the big animal there, right? So you must, and if you want those numbers separately, these are hard actuals, etc. Shweta will probably end up sharing with you, right? But there's a lot of noise in that 3-year CAGR because Andhra is in the base in 2019-20.
Understood. Secondly, quickly on the margin. So this quarter you have done 13.2. Even if I adjust for the operating deleverage, it's around 14.2. So let's take 14.2 as a starting point, because that 100 basis points you want to anyways recoup in the next 4 to 6 quarters. So let's look at the longer term. So 14.2 as a starting point. Over the next 3 to 4 quarters from that 14.2 starting point, what are the margin tailwinds that you see, and what quantum of those tailwinds do you expect, let's say, over the next 4 quarters?
So, Percy, very difficult to call out here. This is, like I said, we continue to influence the levers, right? So we are happy with what we are seeing on pricing, right? Even October, December, right? There was a fair amount of pricing versus prior year same quarter that has flown in, right? But we also expect the run rates to ramp up, right? Because the price increases that we have got, they will ramp up. Productivity, the big one that you guys are aware, right, is the mono carton removal, etc. So all that will start flowing into the P&L. Inflation, honestly, very difficult to call right now, right? Till when will the Ukraine crisis continue, and therefore the natural gas prices will remain, high, etc., etc. So very difficult to call out, right? But our first target is clearly, as I think one of your predecessors mentioned on the call, from this 13.2, get to the 15, right? First, and then we will probably take it from there, right? The supply agility program, right? That may not deliver too much in the first 12 to 18 months, right? Because first we have to execute the actions, and only then the benefits of those, lower conversion costs, etc., will start coming into the P&L. Right? So that's the way I would want to leave it. Our first aspiration is to get back to about 15, and then we see how we take it from there.
And how long do you think it will take for you to get back to that first milestone?
Yeah, won't want to call that out, Percy, right now. Wait a second.
Okay.
Won't want to call that.
That's all from me. Thanks and all.
Had it been a free pricing category, I would have been in a better, we would have been in a better position, right? But there are those constraints in this category. So we are giving it a best shot, and we would want to get there as soon as possible.
Sure. Understand. Thanks and all the best.
Thanks, Percy.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. So my question is really on pricing again. You've seen a state of pricing over the last 12 months. You said it's probably the best phase that you've had. I was just wondering as you go into the next policy season over the next few months, I just wanted to get your sense on your confidence level on probably going back to some of these states and saying, look, we may, they're back, we may need some more going forward as well. How do you see that dynamic playing out, and do you believe your success rates could be similar to what you've seen in the last 12 months?
I can answer what we will do. I can't answer the question of whether the success rate will be the same or not, but we would obviously strive to have the same. So, pricing is a continuous advocacy for us, right? So just because we've got this pricing, clearly inflation is still roaring ahead of the pricing, right? So we are definitely back with all the states on pricing advocacy, and we will continue to drive that quite hard. Both as an industry and as a company, we continue to do that. We are getting into the excise cycles now. This is the time when the advocacy is at its highest. So the team is on it. We continue to advocate for it. I mean, you may still see some media releases even by ISWAI on price increases and inflation, right? And, we advocate both for immediate price increases, and we are advocating with the government for a more fundamental restructuring of the way pricing is handled for this industry. Will we be successful? We don't know. We know these are, these things take time, right? And we continue to work closely with the governments to try and reach some, conclusion. So the answer is absolutely. We are going back to the government and asking for more pricing.
Got it. And my second question is on the competitive environment. Given that you're such a large entity, there is a very high, ability to kind of, manage the cost structure. But for certain smaller competitors, that might be even harder. So, are you seeing in the market that given this inflation, the competitive intensity on media or otherwise has kind of come off? Is that something you're seeing, or you still at a fairly high clip?
I mean, I don't think the competitive intensity is coming off, right? So we've had a lot of new people come into the market and launch new offerings. And we have always said that actually competition is good for this category because of the low penetration levels in the country. And, especially if you look at the prestige and above category, and especially as you go higher up the, pricing ladder, I mean, scotches are hardly 3-4 percentage points penetration. Prestige also, at the upper levels is 25-30% penetration. So competition is good. It continues. There are many new players, many new types of offers in the market. And, the consumer is demanding that, right? So consumer is experimenting. Even the white spirits area is growing quite fast. So if you look at our performance on gin, on Smirnoff, we are seeing, good growth, robust growth there. So I don't see intensity relenting. I just see different players, coming in with new offers and more innovation happening actually. And we have intensified our innovations and renovations, as you can see from our last few months. And we are continuing to keep the tension on our innovation process, right, so that we can cater to the evolving needs of the consumer.
Thanks, Nalda.
Thank you.
The next question is from the line of Anil Shah from Aditya Birla Capital. Please go ahead.
Yeah, good evening.
Hi, Anil.
Yeah, hi. I just wanted to go back, to why really did we do the slump sale? Because if, mathematically when I look at it, not only was the the slum sale products, giving me margins, EBITDA margins positive of 42 for the quarter, plus they were actually taking care of the fixed overheads of the other side. So if I look at it, literally tells me that margins for the slum sale were higher than company average. So A, please explain, let's go back to the drawing board. All the time we've been talking about margins will improve because we will only do P&A. But it seems like margins were much better here, number one. Two, if you're going to recoup this, 90 crores for 9 months, I'm assuming 105, 110 crores, let's say, for the year. We've talked about recouping this in the next 4 to 6 quarters. So if we are currently around 13.2% margins, I'm assuming this will, if I add back this in the next 4 to 6, as you said, 4 to 6 quarters, we'll be back at 14.5 plus 15. On top of that, can I then assume that the productivity gains that we talked about, in which we are, working out and the board has approved, will add another 130 to 150 crores productivity over the period of 2 to 3 years, and not necessarily in the next 18 months. The next 18 months, this will kick in. The rebasing part will kick in. So is that understanding right, or is there certain things which are double counting here?
Yeah. So, Anil, let me just go back to your first question, right? I think that's absolutely the bullseye question, even though we have answered it earlier, right? I don't think when we took the call to divest the portfolio, it was a mathematical equation for us, right? It wasn't.
And it was not better margin.
Yeah, and it was not better margin, right? So, but we leave that, right? And that's why we have been very, very transparent in sharing, right? The numbers are still diluted to the portfolio, right? But yeah, I don't think that's the big driver. The big driver has always been, do we have a long-term right to succeed in that segment?
Yes.
Right? And very, very clearly, right, we had consciously, after a lot of work and diligence, genuinely landed at the conclusion that no, we do not have a long-term right to succeed. And in fact, we would say that we probably delayed the divestiture for about 2 to 3 years, right? And we only were eroding value of the portfolio, right? But maybe, let me just...
Yeah, I think the other one, Anil, I would say is that there were 2 assessments, right? Which way is the market going? And if you look at the market segment development, well before even I came in, it was very clear that the popular segment is declining and what is taking off is prestige and above. And that is going to be the longer term future trend for this market, right? So one was, where are the future profit pools going to lie? And the second was, where do we have the long-term rights to win? And when you marry the two, this was active portfolio management, and it is absolutely proven that companies that do active portfolio management to play to their strengths and core capabilities win in the long term, right? So, as a prudent, active portfolio management exercise, it was absolutely the right thing to do for this business. And Pradeep has commented on the financials of the business. It was not accretive to the business. Right? It would have been under huge pressure with this macroeconomic environment. Please do not play to this portfolio. Not play to our rules in this portfolio, right? So therefore, the longer term right to succeed was very low.
And then the last bit, right? There is enough in the bridges that we have given you. You will also get a sense of what that portfolio delivers, right, in the current environment, right? So if you look at the 53 crores on the 700 crores in the first 6 months, you see the pace at which, right, in the current inflationary environment, that part of the portfolio decimates. Right? So yeah, I guess
double counting in the gains that we should expect going forward.
No, so gains. Look again, like I said earlier, Anil. We have been very, very disciplined as a discretionary, in terms of discretionary overheads management, right? Ind AS is a little complicated because it clubs the fixed overheads along with the variable overheads. In IFRS, it gives a better sense. I can tell you that our fixed discretionary overheads, or the corporate overheads, are 20% below what they were 5 years ago, right? And this is after providing industry competitive annual increment cycles to our employees, right? So that's the level of kind of, rigor that we have maintained in our discretionary overheads management. Now, you're absolutely right, that will be a law of diminishing returns, right? So now we can't cut further, because if we cut further, we'll start cutting into the muscle, right? So therefore, we have to grow out of it now. We have to absolutely grow out of it, right? And that we believe we will recoup whatever we've lost. We've lost about 1,300 crores of NSV. We are very confident that we will be able to recoup this over the next 4 to 6 quarters.
I'm sorry, I'm going to ask the question again, and I won't mind if I can get some numerical answers this, please. I'm again saying, you said that we will recoup in the next 4 to 6 quarters or 12 to 18 months whatever we've lost out as far as the deal is concerned, the slum sale is concerned. Right? That's about 110. It's 90 crores for the first 9 months as per your chart, or as per the the table that you put in. I'm assuming it will be 105, 110 or 120 crores max for the year. Hypothetically, we will recoup this. On top of that, we've talked about a new plan which the board has approved, where we've talked about 130 to 150 crores productivity gains kicking in after 18 months.
No, Anil, that's not right? So let me clarify again. The first part, you're absolutely right? The operating deleverage, we should be able to recoup. Basically, if I just put it another way, whatever NSV we have surrendered through the divestiture, right, we should recoup that NSV over the next 4 to 6 quarters by keeping our fixed overheads flat, right? That's the way I would want to kind of dimensionalize it, right? And the moment that happens, we would have recouped it. Yeah, correct? That's one, right? So hope that's clear. The second one is, supply agility is a 3-year program, right? And initiatives will keep kicking in incrementally. The first set of initiatives will kick in after 12 to 18 months, when the first set of actions are completed, right? It's a 3-year program.
It will deliver in the next 12 to 18 months, after the next 12 to 18 months.
No, it will start delivering in the next 12 to 18 months. It's a 3-year program. All our actions will be completed by, let's say, we are in 23 January. All our actions will hopefully be completed by 2026 January, right? And whatever actions we complete by 2026 January will only deliver in 26-27, right? So once all is completed, we will see an annualized flow through of anything between 130 to 150 crores, right? Not to say that the first set of savings will kick in from 2026, right? As we take the first set of actions, those savings are partial savings.
It's a phased saving program. Make it simpler, yeah?
It's a phased saving program.
And yes, it comes after 12, 18 months.
Which is exactly what I'm saying. So there's, there are two separate tracks as far as getting back the first one is the next 12 to 18 months, getting back in terms of the rebase, and then the kicking in terms of the
yes, absolutely.
That's exactly the point. And on top of that, whatever we do as far as the mix is concerned, the product pricing from the various governments is concerned, is a separate part.
Absolutely. That's the right way to take it, right? I mean, that's a game of inflation, productivity, pricing, mix, etc., right?
Yeah, I understood this part. However, I would, genuinely like to have a call offline to really go back into understanding in terms of, while I understand the long term, in terms of active portfolio, when a product is contributing, even in terms of fixed cost, corporate overheads, to sell that off, still not able to sink that in. Sorry.
Happy to have that call, Anil, right? I mean, Latika can reach out to Shweta. We'll be happy to kind of.
Yeah. Thanks, Anil.
Thank you. The next question is from the line of Alok Shah from Ambit Capital. Please go ahead.
Hi. My question is,
Your voice is breaking.
Mr. Alok Shah, we are unable to hear you.
Can you hear now?
Yes, it's better.
Yeah. Thank you for the opportunity. My question was, just an extension of what Anil asked. Can you elaborate more on the supply agility program? Firstly, what are you exactly planning to do over here with respect to timelines? And then, of course, the benefit is something that you already explained earlier. But with respect to the actions, if you can sort of help us understand.
We already shared everything that we had to share. Am I missing something? I didn't get your question. We've already shared everything in the response to Anil's question.
No. So one is with respect to, with respect to the factory closure or the severances is one thing. Apart from that, any other program that we are driving which will help us with respect to the cost savings?
Yeah. So there will be a combination of, there will be a few other programs. We don't want to get into that level of detail, right, in this call. We will be happy to kind of, have that offline call and talk about some of those things.
Okay, sure. That's it from my side.
Thank you.
Okay, I think, Shweta?
Ladies and gentlemen, this was the last question for today. I now hand the conference over to Ms. Shweta Arora for closing comments.
Thank you. With this, I close today's call. For any follow-up questions or clarifications, please feel free to reach out to me. Thank you for joining.
Thank you very much. Really appreciate the interactions as always. Bye-bye.
Thank you.
Thank you. On behalf of United Spirits, that concludes this conference. Thank you for joining us, and you may now disconnect your line.